Good morning, everyone. Thank you for hopping on to today's webinar on cost segregation. My name is Peter Sachik. I'm UHY's Career Development and Training Manager. To talk to you more about cost segregation, we have Heather Benson from UHY here. But before I turn it over to Heather and give her a little introduction, I want to do a couple housekeeping items for you around CPE. This session does qualify for 1 credit in taxes for CPE. Now, to earn your CPE credit for today's webinar, you'll need to stay in the session for at least 50 minutes, that's 50, and answer 3 of the 4 polling questions we have prepared for you. You do that, you get your CPE credit. Pretty straightforward. Now, a little bit about Heather before I turn it over to her. Since launching her career, Heather has completed more than 700 studies of all property types, including multifamily residential homes, assisted living or nursing home facilities, restaurants, auto body dealerships or repair shops, manufacturing, self-storage, medical facilities, business office suites, retail shopping centers, among others. She provides cost segregation services for all property types, including previously acquired or look-back, newly acquired, 1031 exchange, newly constructed, renovated, expanded, and tenant improvement property. Heather is involved in all aspects of a cost segregation study, including the estimate of benefit analysis and consultation, physical on-site inspection, identifying real and personal property assets, estimating asset costs, engineered drawing review, basic reconciliation, and final report deliverables. I'll be monitoring questions as Heather goes through her presentations, but I would like to welcome to the stage Ms. Heather Benson.
Hi, everyone. Thank you, Peter, for that introduction. Thank you all for joining me this morning. We're going to talk all about cost segregation. So I'll just dive right in and go over what we will be covering today. So I'm going to give you a brief overview of what cost segregation is. I know a lot of you are probably familiar, but I'm sure some of you are here to learn what cost segregation actually is. So we'll do an overview so you have an understanding. Then we'll touch on who can benefit from a study. Then I will go over the difference in recovery lives. So we will be looking at the difference between 1250 real property and 1245 personal property. Then we will take a look at cost segregation studies from a tax savings perspective, which I'm sure you're all very excited for that portion of the project. That's very important because that's why they are so beneficial. We will look at how bonus depreciation and quality improvement property, also known as QIP, add additional tax savings. Then I will walk you through a real life case study example for a study that I completed and show you the results. And I will also compare the results of that study with and without bonus applied so you can see a little bit how bonus adds an additional benefit and also how studies are still going to be beneficial if bonus is not applied. And then at the end, we will have a portion dedicated to questions. So if you have any questions as I'm going through the presentation, please just make note of them, and then there will be time at the end and I will answer any questions that you have. So let's get started. What is cost segregation? So cost segregation is a tax savings tool that's going to be applied to commercial real estate. The purpose of a cost segregation study is going to be to identify assets within the building structure that can be segregated out of the depreciable basis costs and into accelerated recovery lives. So we are reallocating costs within the depreciable basis into appropriate classes and recovery periods, and this will provide an accurate depreciation calculation. So without a study, a building and the land improvements would typically just go on the depreciation schedule as a 1250 real property asset, and it's considered to be a structural component. So this would be depreciated over a 27.5-year period if it's a residential property. So that would be like apartment homes. 39-year if it's non-residential, and then 40-year if you're using the ADS method instead of makers. In those long recovery lives, the depreciation expense would be calculated over those recovery lives, leaving very little depreciation expense and very little tax benefit. So what a cost segregation study does is it will identify assets in the building and the land improvements that can be accelerated for depreciation. These assets qualify as 1245 personal property. And those assets will typically be recovered over a 5-year period for personal property, 7-year if it's furniture, fixtures, and equipment, and also 7-year for personal property within most types of manufacturing facilities. 9-year for personal property using the ADS method instead of makers, and 15-year for land improvements. And if you're using the ADS method, it would be 20-year for the land improvements. So who can benefit from a cost segregation study? Commercial real estate owners are going to be those who can benefit from a study. We can do studies on properties that were acquired. It can be previous or new. If it's previous, it's just considered a look-back study. New construction can be from the ground up, a completely new building. New construction might also look like renovations to an existing property, expansion to an existing property, tenant improvements. And when we look at tenant improvements, we want to look at who is paying for those tenant improvements. So if the owner or the landlord is paying, they can benefit from a study. If the tenant themselves are paying for the improvements, they can benefit. If they're both paying and contributing, then they can both benefit. So when it comes to tenant improvements, it might not necessarily be the owner of the building, but we really want to pay attention to who is paying for those improvements in those situations. Less common property types that we do cost segregation studies on, but can still benefit from a study, include 1031 exchange, tenancy in common agreements, step up in basis, and real estate investment trusts. So industry types of examples, I know Peter mentioned this in my introduction, but I'll just, kind of go over them a little bit quickly. So multifamily residential, assisted living facilities, mixed use properties. So your mixed use will be your residential homes that also have like retail mixed in. So sometimes they have coffee shops, restaurants, flex office space, and different things like that. Hotels, restaurants, business offices, medical offices. I've done larger office buildings such as hospitals or surgery centers or dialysis centers, light industrial warehouses, manufacturing facilities, self-storage facilities, auto dealerships, and within the dealership industry, there's also the mechanical and body shops, retail shopping centers, grocery stores, and veterinary and animal care facilities. So that brings us already to our polling question 1. What is the purpose of a cost segregation study? So A, to reallocate the depreciable cost basis of a property into appropriate class lives and recovery periods. B, to identify assets that can be accelerated for depreciation. C, to increase depreciation expense for tax savings purposes, or D, all of the above.
All right, Heather, looks like the results of that poll were that we had 4% say to reallocate depreciable costs. We had 3% to identify assets, 0% to increase depreciation expense, 93% said all of the above.
Okay, great. So we had 93% answer. All of those are applicable to the purpose of a study. So next I want to do an overview of the difference between 1250 real property and 1245 personal property, so you gain a better understanding of what these studies are and what they do. So 1250 real property is going to be the building structure. The IRS defines a building as a structure that's enclosed within 4 walls. It's typically covered by a roof, and the purpose of the building is to provide shelter, housing, work, parking, or sales space. When they say parking, you want to think of like your parking garage that would have, typically 4 walls and a roof over it. The IRS further defines structural components of a building to include walls, partitions, permanent floorings. So permanent floorings are going to be any type of tile, like ceramic tile, quarry tile, marble tile. It would also include cement floorings, sealed cement floorings like epoxy floorings. So those are all considered to be permanent in nature, and also traditional hardwood. They also include ceilings, windows, doors, stairs, elevators, and all the systems that are required to run and maintain a building. So that's going to be your mechanical, which is the heating and cooling, electrical, plumbing, and fire protection, which will include the wet pipe sprinkler system, and also the fire alarms. So the IRS also further goes into the definition of a building and excludes certain items from the definition. So excluded from the IRS definition of a building is any structure essential to machinery or equipment. So what they mean by any structure essential to machinery or equipment is anything within the building that is supporting the machinery or equipment. This could be electrical outlets, it could be electrical wiring, it could be process plumbing lines, dedicated ductwork. For example, within the automotive industry, within the body shops, a lot of times there are paint booths set up, and there will be duct work that is connected to the paint booths to remove the fumes out of the building. So that would be an example of duct work that's in place for the machinery. Structure, which houses property used as an integral part of an activity. So we want to take into consideration what the building is operating as. So for example, within a restaurant, there's going to be a commercial kitchen, and within the kitchen, there are always floor drains to collect the water runoff from kitchen equipment. And you can go into a bathroom within a building, and typically there's floor drains in the bathroom. These could be very similar floor drains, sometimes they're the same. That floor drain within the restaurant is going to be an integral part of the activity of the building operating and running as a restaurant, whereas that floor drain in the bathroom is considered just to be part of the primary plumbing system. So that the one in the bathroom is going to be real property, as the one in the kitchen itself is going to be an integral part of an activity. So that would be considered 1245 personal property. If the use of the structure is closely related to the use of the property, so that's just very similar to what I just went over. It's just kind of worded a little bit differently. And if you use the structure, if the use of the structure clearly can be expected to be replaced. So this is going to be anything that's not permanent in nature. As I was talking about the permanent floorings like ceramic tile, when you think of other floorings like carpeting or vinyl floorings, those can be expected to be replaced and they're easily removable. So those are not considered part of the building structure. So that takes us into what 1245 personal property is. So 1245 personal property is the exclusion of those items that I just went over. And just to put it in less IRS wordy definitions, you want to think of anything that's easily removable. So that will be like your carpeting, your vinyl floorings, base cabinetry and countertops and wall cabinets, specialty millwork items. Those are all considered to be easily removable. If it's decorative in nature, that would be like certain wall coverings, certain millwork items, specialty lighting fixtures. If the asset is specialty to the industry it's operating as, like the example I gave as the floor drains, those floor drains are specifically there for the kitchen, so it's specialty to the building operating as a restaurant. Components dedicated to machinery and other equipment, so this could be, you know, an outlet that's in the building. Its dedicated purpose is to support a computer for office, so it doesn't have to be, you know, extremely large machines or equipment. It could be simple equipment such as a computer or kitchen appliances, or it could be larger machines and equipment in facilities such as manufacturing. And then we have secondary systems. So secondary systems would be a good example is a lighting system. Typically within like office buildings, restaurants, you're going to have your primary lighting system that are fluorescent fixtures within the ACT tiles of the ceiling. And then we might have decorative lighting throughout, which includes pendant lights, recess lights, accent wall fixtures, track lighting. Those are all considered to be a secondary system because it's not a part of the primary lighting. And we can apply the same concepts to plumbing and mechanical. The main plumbing system would run to the bathrooms of the building. And then if we have plumbing that's dedicated to appliances, it's considered secondary. And then with HVAC, your heating and cooling systems, anything that's not the main heating and cooling of the building would be considered a secondary system. So the third component of a study is going to be your land improvements, which are accelerated over a 15-year period. So the land improvements actually have both 1250 real property and 1245 personal property within them. Typically, most of what you see on a land within a commercial property is going to be classified as 1245 personal property land improvements, which have the 15-year accelerated deduction. But there's also going to be a few components that need to be designated to the building. They're considered to be structural in nature and related to the building structure itself. So they are going to be classified as the 1250 real property. So that's going to include certain utility lines like your main water, your main electrical, gas lines, and then the grading associated to put those utility lines in. Also building pad grading. So grading that's done to the dirt to put that building pad in place is going to be considered necessary for the building structure. So just those few items would be considered to be real property. So then the personal property is going to be pretty much everything else we see that is an improvement made to the land. This would include like your asphalt paving, your concrete paving, landscaping, complex signage, dumpster enclosures, fencing, storm drainage, retention ponds, swimming pools. So pretty much everything, almost everything you see is going to be that 15-year land improvement. Next, I just want to kind of go through, the different categories so you have an idea of the 1250 versus 1245 examples. So your building shell, you're going to have your standard exterior finishes, doors, windows, and roof that are part of the building structure. But you might have decorative awnings, building signage, building lettering. Those would all be considered to be easily removable and an accent to the property, so they would be 1245 personal. And also, in manufacturing and distribution facilities, typically there's overhead doors, and they have the door dock seals and the door dock bumpers that would be considered specialty to the industry. Doors and windows, most of your doors and windows are always going to be 1250 real property. There are some that qualify as personal property. The double swing impact doors that are most often seen in restaurants, sometimes they're in retail stores too. They're doors that are very lightweight and they swing open really easily. They allow the workers to go from the kitchen to the dining room really quickly. Those are considered to be specialty in nature. And interior high-speed roll-up doors within manufacturing facilities as well. Finishes, you're going to have your standard drywall, paint, and permanent flooring all be building structure, while you'll have wallpaper, different types of wall coverings like fiberglass reinforced wall panels, removable flooring, including carpeting, vinyl strip flooring, resilient tile. Those would all be considered to be specialty finishes. Within carpentry and millwork, your building framing will always be building structure, and bathroom vanities as well. So the bathroom vanities would include like the cabinets and the countertops. The IRS considers those to be necessary to the plumbing of the building. But when you have base cabinets and countertops throughout the rest of the building, they're considered 1245 personal property as long as they're not in the bathroom. So we just want to keep in mind that bathroom vanities are not a 5-year asset. And then the other 5-year assets would just be like your baseboard moldings, crown moldings, wainscot moldings, base cabinets, countertops, wall cabinets, wood wall paneling, and any just type of millwork that's throughout the building. So electrical, plumbing, and HVAC, you have your main systems as I talked about earlier, and then you have your secondary items that are going to be specialty in nature. Electrical, if we have any outlets that are dedicated to equipment, are considered to be a special purpose outlets. Your general outlets throughout the building would be part of the primary system. If we have any specialty wiring that's in place for machines or appliances, security cameras, sound systems, site lighting, so aluminum light poles that are throughout the parking lot, Those, even though they're on the land, they're not considered to be a land improvement. Site lighting is an electrical item, so it gets classified in a 5-year recovery life. Plumbing, we have kitchen sinks, as long as it's a non-residential facility. Kitchen sinks within an apartment home are considered to be necessary to the building structure. So kitchen sinks in an apartment home would be reclassified or classified within the building structure as a 27.5-year asset, whereas kitchen sinks in like break rooms, medical offices, conference rooms, those would all be considered to be specialty. We also would have like compressed air piping, typically seen in auto dealerships and manufacturing facilities, interior hose bibs, floor drains, and floor sinks, as long as they're not within bathrooms, grease traps, and plumbing that's dedicated to any machinery or appliances. So you could have like a refrigerator in a break room that has a water line to the ice machine, and that would be considered a specialty asset. HVAC, we would have exhaust fans that can be dedicated to kitchen equipment, venting that's dedicated to clothes dryers. Typically that's seen, in apartment homes. Any ductwork or venting that's dedicated to equipment. And then in IT rooms, we have PTEC units. So those units are used to keep the room at a specific temperature that's required for the equipment. So they're considered to have a special purpose. Auto body, we have exhaust systems in the body shop that remove the vehicle exhaust fumes from the air. And then interior refrigeration panels. So those would be like your walk-in coolers and walk-in freezers that are in restaurants to store the food. Next, we have polling question number 2. So what is an example of 1245 personal property? Our options are A, a new roof, B, the main lighting system, C, carpeting, or D, ceramic tile.
And for this poll, Heather, we have 15% a new roof, 17% the main lighting system, 56% carpeting, 13% ceramic tile.
Okay, so not as good as the last one, but we still had 56%. So your new roof, that's part of the building structure because it's, defined by the IRS that a roof is part of the building structure. The main lighting system is as well. The difference between carpeting and ceramic tile, the carpeting is considered easily removable, so that's a personal property asset, so that's the correct answer here. And ceramic tile is considered to be a permanent flooring that's not easily removed. All right, so let's keep going. How does this help from a tax savings perspective? So let's take a look at these studies and how they impact our tax savings. So those longer recovery lives of the building structure, the 27.5-year, 39-year, or 40-year, has a very low depreciation expense over those long recovery lives, which results in a lower tax deduction. So the accelerated class lives of personal property assets will increase the depreciation expense, which result in a larger tax deduction and allows for an increase in cash flow. So on average, a study will typically reclassify between 20 and 40% of the depreciable cost basis into those accelerated recovery lives. The results of the study typically depend on several factors. It can depend on the industry type the building is operating as, specialty structures within the building. So if the building had a lot of easily removable items, if it had a lot of decorative items, that would increase the benefit. The building size can have an impact in both ways. If the building size is very large and has a lot of structural costs, that could decrease the benefit. But if the building is very large and has a lot of assets that can be reclassified, that can increase the benefit as well. The lot size, so a larger lot is going to result in a higher amount of land improvements, which will increase the benefits of a study. And just the different types of finishes and items that are within the building. Bonus depreciation and quality improvement property also allow for additional tax savings, which I'm going to talk about next. So bonus depreciation allows for assets that have a maker's class life of 20 years or less. So that's going to be your 5-year personal property and your 15-year land improvements or 15-year QIP. And also your 7-year items to be fully accelerated and deducted in that first year. So that adds an additional tax benefit to our clients because we're able to deduct those assets fully in year 1 instead of over their traditional recovery life period. So right now, the IRS has some rules in place for bonus depreciation. So the placed in service date for 100% bonus depreciation qualification is between September 28th, 2017 and December 31st, 2022. So once we hit January 1 of next year, which was 2023, bonus depreciation will decrease at 20% each year following until it reaches 0% in 2027. And there's still going to be benefit of bonus depreciation or benefit of a study with and without bonus depreciation. Bonus depreciation just adds that additional impact on year 1 because we're able to fully deduct those assets in that year. And I'm going to look at that in a little bit of more detail once we look at the case study. So quality improvement property is when we do renovations to an existing footprint, which is really important to remember. So the renovations have to be made interior to the building and to an existing footprint. So when you think of QIP, those are the 2 main qualification items. It must be interior and it must be to an existing footprint. It cannot be an expansion to an existing facility because that's not, within an existing footprint. That's considered to be new construction. So the place in service date right now, the IRS has the rule for quality improvement property. It must be after December 31st, 2017. So what quality improvement property does is assets that are typically structural components within the build that are made in the renovations that would have a recovery life of 39 years can be accelerated into a 15-year recovery period. So what does this look like? So if we were to make renovations on an existing footprint and let's say we put down new ceramic tile. And as we've talked about ceramic tile, that's considered to be permanent in nature. That would be a 39-year asset. But when it's made to an existing footprint as a renovation, instead of being classified as 39-year, it gets accelerated into 15. Other examples would be like new interior walls, paint that goes on the walls, new electrical, plumbing, and fire suppression systems, as long as they're interior to the building. So those primary systems, if we're replacing them to an existing footprint, as long as those components are interior, they can classify as a 15-year asset. And then components of the HVAC system. So typically when we see replacements of HVAC systems, so that's heating and cooling, there is usually exterior components such as rooftop units or split systems units. So we would calculate the cost of those rooftop and split systems and take it out. And then the duct work within the building is going to be considered a 15-year quality improvement property item. The IRS does not allow for elevators and escalators to be accelerated into 15-year, and it does not allow for structural framing. So any structural framing necessary to hold the building up. So this can allow for a higher percentage to be reclassified. Renovations really depend on what is being done. So we can have a renovation that is doing all interior work, and this would be potentially up to 100% to be reclassified within a 5 or 15-year recovery period. And then I've seen clients do renovations where they do like a facelift to the building and they completely redo the exterior of the building. Like they paint the building, they put new exterior doors and windows and a new roof. And that unfortunately would not be a good candidate for a study because those improvements could not be reclassified into a shorter recovery life. So it really just depends on what is being done. But typically with renovations, we see a higher percent reclassified. Polling question number 3. which would qualify for QIP. So this is what we just went over. Would it be new exterior doors and windows, new ceramic tile in an existing space, a new roof on an existing property, or an expansion of a property?
Okay, for this one, Heather, we had 20% new exterior doors and windows, 41% new ceramic tile in an existing space, 10% a new roof on an existing property, 29% an expansion of a property.
Oh, okay. So the answer here is B, the new ceramic tile, because it has to be within an existing space. So I think you said there was about 20% that's at an expansion of a property. That's not going to qualify because that's considered to be new construction. So just remember with QIP, it must be within an existing footprint. It cannot be new, an expansion would be a completely new footprint. So ceramic tile is the right answer for that one. Ceramic tile in an existing space, that is. So next I want to show you a real life example of how we see benefits in a study. So I had a client purchase a retail shopping center for $3.4 million. So the standard depreciation deduction for that year would have been $83,674. So I was able to reclassify 27% of the depreciable basis into a 5-year recovery period and a 21% into a 15-year. This allowed the total deduction for year one, because they were eligible for bonus depreciation, to be $1.63 million. So as you can see, that total deduction in year one went from $83,000 up to $1.6 million, which is a huge increase for our client. That increased their depreciation expense by $1.59 million. Their after-tax increase in cash flow was $518,000, and the net present value of the study, so the net present value throughout the life of the study over that 39-year period, was $316,000. So as you can see, these studies can give huge benefit and huge tax savings, and it's a great way to increase cash flow, especially now when we have bonus depreciation, and you can get that benefit all upfront in the first year. A lot of times, when we are doing the first year of a property, that's when the highest costs are incurred. So it can be extra beneficial to do a study right when those costs are incurring to either build the property, acquire the property. So it can really help from a tax savings perspective. But I also want to walk you through what the benefit would look like if we did not take bonus depreciation. So you can get an understanding of kind of the difference between bonus depreciation being applied and then when it's not applied, because there's still going to be a similar benefit without it being applied. It's just a little bit different. So this first table here is outlining the benefit of the study with bonus applied. So if you look in these first two dark blue columns, that's accelerating the 5 and the 15-year assets fully in the first year. And then over here in the lighter blue columns, that's showing the results of the study. So we see an increase in depreciation expense that first year, which is huge. That increase was $1.59 million. And then the after-tax increase in cash flow and the net present value savings. So we're going to have that impact all in the first year. And then the standard deductions would have been in the years following $87,176. So after that first year, we have less of a depreciable basis to recover, so the standard deductions go down. So the standard deductions the years following after we perform the cost segregation studies go from 87 to 41,000. So we have that impact all in the first year, which is a really good benefit for our client. And then the standard deduction is going to be less the years following. So then let's take a look without bonus applied. So this is recovering the assets over their traditional class life, so over the 5-year and the 15-year. So we'll see an increase in depreciation expense, not only in the first year, but it's going to be carried out mostly in years 1 through 5. So if you look at this first light blue column over to your right-hand side, you can see that the increase in depreciation expense is incurring from years 1 through 5, and then also a little bit in the following years up to year 15 when we're recovering the land improvements. So we're not going to see a benefit just in year 1. We're going to see a benefit over a 5-year period for the most part, and then a little bit more over the remaining 10 years after that, over the 15-year period. So what does this look like when we compare them side by side? So on this table, I just put together the results of the study with and without bonus applied. The middle row right here is with bonus and the bottom row is without. So the total accelerated is obviously the same because it's the same study, so we're accelerating the same amount. So your biggest difference is in year 1 when we have the year 1 deduction, when we have the 1.63 because we were able to fully deduct those assets. And then without, the deduction was $427,000 because we're recovering those assets over the 5 and 15-year recovery lives and not fully in the first year. So your increase in depreciation expense, that's going to have a big difference in year 1 between 1.59 and 343. But when we look at, so that's the standard deduction would have been, I think it was 87,000. The increase in depreciation expense of 343,000 is still a really good benefit for the client that's doing the study. But then if we look at the increase in depreciation expense over the 5 and 15-year periods, remember when we looked at that first table where bonus was applied, the depreciation expense was less than the standard deduction. So the increase in depreciation expense reduces when we look at it cumulatively in a 5 and 15-year period, and then without bonus, it increases because we're still recovering those assets. So when we hit the 5-year mark with bonus applied, the increase in depreciation is 1.4 million, and without bonus, the increase in depreciation is 997,000. So we're getting to be more comparable. It's still more of a benefit to have the bonus, but it's getting to be comparable without. And then when we hit the 15-year mark, with bonus applied, the increase in depreciation accumulative over the 15 years was 1.006 million, and without bonus, it's 1,730,000. So there's only a difference of $6,000. So we just want to kind of keep this in mind, you know, as bonus changes, the benefit of a study is still going to be there. It's just going to be over that 5 and the 15-year period and not all in year 1. And what does this look like when we look at the increase in cash flow? So that increase in cash flow, there's going to be a difference in year 1 with or without bonus applied. So with bonus applied, the increase in cash flow is 523,000 that first year, and without, it's 111,000. But then when we look at it over a 5-year period, it's 468,000 with bonus applied and 325 without. So it's not as big of a difference there. And then when we hit that 15-year mark, once all of the land improvements have been accelerated, the difference looks like 330,000 compared to 326,000. So we only have a difference of about $4,000 without bonus applied once the assets are fully recovered over that 5 and 15-year period. So it's not as huge of a difference as you think. It just takes longer to receive that impact because we're recovering it over the 5 and the 15-year period. And then we look at the net present value of the study. So the net present value with bonus was 316,000 and without it's 225. So there's a little bit of a difference there. But it's not as big of a difference. When you see that year 1 deduction, it looks like the impact is so large, but when you break it down and look at it, how it actually calculates over the recovery lives, it's very similar, and it just demonstrates that cost segregation studies still have a really good benefit when there's going to be, you know, that reduction in bonus, or if you choose not to take bonus depreciation. So next, I just want to walk you through an example of QIP to give you a case study of what that looks like. So I had a client perform renovations in an office space. Their total renovations were 4.94 million. So the standard deduction for these renovations would have been 121,000. So what they did, they purchased a building and they ended up completely gutting and remodeling it, but they kept the building structure itself. So they did all of these improvements within an existing space. And once I performed the study, I was able to reclassify 18% into 5-year property, 9% into 7-year furniture, fixtures, and equipment, 19% into 15-year land improvements. So they also made improvements to the site of the property that qualified for land improvements. And then 30% was able to go into 15-year QIP. So they had an additional 30% that would have otherwise not been reclassified. So this was 938,000. So close to $1 million, which was accelerated. And in this instance, these assets were all eligible for bonus depreciation and could be fully deducted in that first year. So the total accelerated of the study was 74%. And as I talked about study results earlier, our typical results are between 25 and 40%. So as you can see, that extra 30% really bumped us up. And reclassifying 74% of a depreciable basis is a huge amount. So we accelerated 3.75 million. And our increase in depreciation expense was 3.63 million. And the net present value of the study for that over the life of the project was 600,114. So that concludes our presentation today, and we have our last polling question. So polling question number 4, which is true of bonus depreciation? It allows assets with a maker's class life of 20 years or less to be fully deducted in the first year. It will begin decreasing at 20% starting January 1, 2023. It adds an additional impact on tax deductions in year 1, or D, all of the above.
All right, for this one, Heather, we have 5% where for qualifying assets can be fully deducted, 2% begin decreasing at 20% each year, 3% adds additional impact on tax deductions, and 91% said all of the above.
Okay, great. Those are great results. So yes, it is all of the above. That all applies to bonus depreciation.